the battle begins, right? It's the bull bear debate. And on the technical side, there's a lot of really good bullish stuff that's going on. On the fundamental side, there's not a lot of good things that are going on between the Fed hiking rates, still doing quantitative tightening.
Welcome to Wealthion. I'm Wealthion founder Adam Taggart, welcoming you back for another weekly market update with my good friend Lance Roberts, who's now officially set up in his new home office. Lance, how are you, buddy?
I'm good. I guess you use that term, good close friend, laxly there, right?
All right. Well, look, Lance, we got a lot going on. We're recording earlier on Friday than we normally do. So I appreciate you doing that. It's because of some constraints on our end here. So the markets haven't exactly closed for the week, folks, but we've got most of the week to talk about here. All right, Lance. Well, look, let's jump right in. Feel free to pick your theme of the week, but it seems to me that the big development this week was the release of the July CPI number midweek, which came down to 8.5% from the previous 9.1% print. So raising questions that inflation may have peaked, but the market certainly seemed to have taken this as positive news. So why don't you run with that? What do you interpret from all that action?
Yeah, well, I mean, it's a lot of hooey, but the bottom line is that yes, inflation came down a little bit. However, actually inflation went up if you stripped out the energy component. So, what everybody kind of missed from the headline is that the entire drop in CPI was just the decline in energy prices, which may not be that long lasting. We could very well see some disruption of supply somewhere, ongoing issues with Ukraine, Russia. There was a pipeline leak in Louisiana today that shut down 600,000 barrels of supply temporarily. So, I mean, there's a lot of things that can happen. All of a sudden, you could wake up one morning, energy prices be back up to $110 a barrel. Wouldn't be surprising. They've gotten very oversold here recently. So, a rally back up in oil prices wouldn't be surprising at all. And of course, that's going to put that inflation push right back on the table. So, it was interesting, though, if you looked at all the different comments coming out from the mainstream media economists, right? Like Jim Paulson from Luthol Group was like, wow, this is the inflation print we've all been looking for. This means the Fed's back to easing, right? No, the Fed's not back to easing at all. In fact, they're going to be hiking rates. We've got Jackson Hole at the end of the month. They're going to hike rates by 50 basis points probably, and that's probably not going to be the last of it either. So, what's interesting is the market's doing exactly the opposite of what you would want if you want the Fed to pivot. The more the stock market goes up,
right,
and the less need there is for the Fed to stop their inflation fight and go back to cutting rates, because there's no financial instability and credit spreads are coming down. High yield yields are coming down, so people are running back into junk bonds as a stock proxy. Stock markets are going up. We're having a fantastic run. And again, you and I talked about this. There was so much negativity in the markets that, it wouldn't take a lot to get this really kind of big run in the markets. That's exactly what's happening. And now we've got exactly what we said we would get. Everybody's back in the bullish camp. Jim Cramer's, crowing the bottom is in. And, this is, kind of exactly what we expected to happen. But the Fed's not stopping their fight anytime soon. And the more the Fed hikes rates, the more they're going to slow economic growth, the more earnings are going to decline, and the more markets are going to have to adjust for that new pricing.
All right. And I do want to give you credit for warning folks about this from a sentiment standpoint, where you had said, look, things had gotten so oversold, so bearish that it wouldn't take much of an even mildly potentially positive trigger to create a pretty big snapback in the market. And that does seem to be what we're seeing here. Yeah. And it's crazy that all of a sudden we're seeing, people basically saying, hey, this is it. The inflation problem's, getting solved. We don't have to worry. Happy days, everybody in the pool. So it's still an 8.5% CPI. It's one of the worst ever in the past 40 years. It's still at a real extreme. Inflation's a real problem at these levels. And to your point, we could go back to a higher CPI print. Now, you and I have been calling for CPI to likely peak. We were off maybe by a month there, and one data point does not yet make a trend. But I think it's fair to say that you and I probably still think that disinflation in the CPI is more likely as the year goes on. And I still believe that, but to your point, I'm still open to the fact that the August CPI print could be higher. So you talked about how energy was what brought down the month over month CPI, or sorry, energy was what brought down the CPI versus last month. There's a lot going on in the energy market right now that makes me think that energy could be contributing to a higher CPI next month. And here's just a couple of quick stats. Gas prices look set to spike higher after dropping below $4 a gallon. Gas stockpiles in the East Coast region are at their lowest absolute level since November 2012, right? So almost 10 years. Seasonally, supplies are near an all-time low in records going back to 1993, right? So we could have some serious supply constraints in gas that start forcing prices back up after this temporary dip that we've seen. But also, if you look at other types of energy sources, so industrial power costs, so this is just getting, electricity, are up 24% from a year ago. That was as of May, and the prognosis is getting even worse. We're seeing this problem even worse in Europe. In the UK, a former UK Prime Minister is calling for a nationalization of the energy utilities there, given how bad things are getting. In Germany, which we know is just in a massive energy crisis right now, Google searches for firewood are exploding. People going out and cutting their own firewood, right? Because the gas is too expensive or they just can't get it, right? So, energy is the hero of this past month. It might not be going forward. I just want to make one last point too, which is Biden got a lot of flack for, I think, poorly speaking the other day, where he said, we had zero inflation in July. And I think what he meant was month over month inflation was flat, and that's what's allowing the CPI to start coming down. Jim Bianco created a chart that we'll put up here. He said that, look, if we have flat monthly inflation going forward for the rest of the year, that only gets us down to a CPI of 6.54 by the end of the year. Right. So CPI is not just going to fall off a cliff anytime soon, no matter how hard the market's partying right now. I just went through that's parade of stats, Lance. Basically just add a lot of validation to your point here, which is like the euphoria that the market is reacting to in this very slight decline in the CPI just seems incredibly mismatched to, everything I just mentioned there.
Well, and there's, energy is kind of an interesting, byproduct here, because, the decline in energy prices had brought down inflation. Okay, great. So let's run up the stock market on that. But also, we just got through earnings season primarily for the second quarter. Had it not been for energy, which only makes up 4% of the index, right? But had it not been for the massive explosion in earnings for energy companies, we would have actually had negative earnings growth in the second quarter. So, nowhere you look, and again, I'm not being bearish here, and we're going to talk about all the bullish stuff here in a minute about the markets, because there's just a bunch of good bullish stuff going on with the markets, and, why it augurs for higher equity allocations right now. But it's important that we keep a little bit of context. And this is really kind of the gist of our newsletter this week that's on our website. So, every weekend we publish a newsletter called the Bull Bear Report on realinvestmentadvice.com. And we just kind of go through the bullish backdrop of the market, the bearish, the bearish things to be watching out for. We bring in a lot of stats from our Simple Advisor research platform. And so we kind of give, readers just kind of an overall weekly update about where we are in the markets. And what's interesting is, and the title of this weekend's report is "The Battle Begins," right? It's the bull bear debate. And, on the technical side, there's a lot of really good bullish stuff that's going on. On the fundamental side, there's not a lot of good things that are going on between the Fed hiking rates, still doing quantitative tightening. Quantitative tightening goes to its full measure in August at 95 billion a month going forward. And there's no indication the Fed is going to back off that. The Fed doesn't like having a $9 trillion balance sheet. They want to get that down to be ready for the next recession whenever it comes. So, there's a lot of things that are going to be dragging on the markets going forward. And, on our website today is a really important article. And I know I'm doing a lot of shameless plugs right now, and I apologize.
Hey, shame away, buddy.
Sorry?
Shame away.
Okay. Well, if you go to our website today, realinvestmentadvice.com, I have a article talking about why long-term returns cannot remain where they are. And what we look at is if you look at the historical trend of growth of equities over time. A lot of people will show you a chart and they'll say, look, if you just invested the markets in 1900, here it is 120 years later, you would have made 10% annualized on a nominal basis. Well, okay, so first of all, just remember you don't live 120 years, but it's a nice theory, right? So when you start matters more than if you start. That's just, and valuations are the entire key behind that, but we'll get to that in a minute. But what's important, that 10% number is important because out of that 10% return number, 6% came from capital appreciation, 4% came from dividends. Okay, so that's your 10%. Now you subtract that inflation of about 2.5% over that long period of time on average. That brings you down to about an 8% annualized growth rate. So that's when you hear people tell you, oh, the market gives you 8% a year. That's where it comes from. Now you don't get 8% a year. That's average. There's long periods in history where your return was either zero or negative. Right. So it's important to remember that. But here's the important thing. From 1900 to 2021, the average return was about 8%-ish, right? So that validates that whole theory. From 2007 till to 2021, which is where I stopped the data, end of the year 2021, the average return increased by 4 full percentage points to 12% annualized. Now, the reason, just bear with me for a moment, and this is why this is so important to understand. Going back 100 years, the economy grows on average at about 6% annualized. That's how you get 6% growth in stock prices, because what drives stock prices is earnings. Earnings from peak to peak run about 6% annualized. So that's how you get your 6% growth, slap on your dividends, subtract inflation. That's how you get your 8%. Now, remember that for a moment, because the economy today is growing at 2%, right? On average. Since 2000, the economy's been growing roughly at 2%.
Right. On average since then, right now, this year it's contracting, but yes.
Well, yeah. So, but on average, right? So, dividend yields are 2%. So, Adam, I know you're a math whiz because you went to Stanford. That's where all the smart people go. So 2% GDP growth, 2% dividend yields. What should my return be on stocks? 4% less inflation at 2%. If the Fed gets to their target, my return on it is 2% going forward. We're at 12. The economy is not growing at a rate to support 12% annualized rates of return, period. Can't do it. End of story. And now you're running 8% inflation on top of that. So, and it's interesting to your point, and this is why this is such an important concept to understand, going forward, is that the earnings that drive the prices of the market have to come from somewhere. Those earnings come from the economy. And so the market can't keep growing at 12%, particularly since that entire 4% overage of the economy came from all the Fed stimulus, monetary policy, fiscal policy. And now the Fed's not doing that anymore. The Fed is removing that temporarily, at least for now. So to suspect, or to expect, I should say, not suspect, but to expect that earnings are going to remain very high, and that as a result, returns are going to remain very high in the markets, is really a dangerous concept when you start thinking about where we are running 8% inflation. And remember, just a couple of months ago, folks, at 8.5% inflation, everybody was freaking out that the Fed was going to have to hike rates to the moon. And that was a terrible thing. And here we are 2 months later at 8.5%. And now it's a great thing. So you've got to keep all these narratives in mind.
You do, and that's a great analysis, Lance. And so, if the earnings haven't been, if the economy has not been growing as fast since 2007, but stock returns have accelerated, that's basically means that the growth and valuation of the market has been from multiple expansion, right? Which is that people have said, okay, we're placing a greater value on future earnings than we were before, right? And I think you did a good job of saying, hey, what probably drove a lot of that was all the tsunami of stimulus that was just getting pushed into the markets there. And in a lot of ways, it's sort of like a Tinkerbell market. And if you remember, in Peter Pan, like Tinkerbell basically, kept her powers and stayed alive because everybody agreed to believe in her, right? And as long as everyone's got the confidence that the Fed's got everybody's back, then you can cross your fingers and we can all agree, okay, stock should be worth more going forward because we all really hope it's going to continue like this, right? But to your point, the Fed is going to, if it looks on track to, if it does what it says it's going to do, it's going to withdraw $500 billion, worth of assets out of its it's going to tighten by $500 billion worth of assets between now and the end of the year, which obviously is the opposite of what it's been doing for that period that you just talked about there. That's going to have real consequences. I mean, that it's hard to keep your faith in the market when the Fed, isn't just tossing out money like it's free, and when the Fed is actually, becoming miserly, it gets real hard to maintain that faith. So it's going to be really interesting to see what happens here. And I guess this sets up the battle royale that you were talking about, right? Which is, okay, when we kind of look at the macro side of things and the fundamentals, we say, oh God, this looks really pretty ugly going forward. And actually, earnings themselves too, estimates are coming down. We're seeing the projections for next year, both for the rest of this year and for next year, are coming down, which also should be pulling asset prices down. But then you've got all the technical stuff that looks good. And actually today, the University of Michigan headline sentiment index surprised to the upside. It had been down at historic lows until last month, but just came up at 55.1, which was an increase from 51.5 from last month, beating expectations of 52.5. So, how important are these technicals at this point? Are they enough to potentially power this market to a new high? Or at some point here, do you think it's got to fizzle out?
So, no, this is the challenging part right now. So, our morning investment policies, meetings are interesting right now because, between Mike and I and Nick and the other members on our team, we talk about these different kind of ebbs and flows of what's going on in the market. So, let's kind of lay out the bull bear case here for a second, right? So if you take a look at the technicals of the markets right now, there's a lot of good bullish action going on. The number of stocks above their 50-day moving average have improved. Breadth has improved markedly. Stocks have climbed above the 50-day moving average. They've climbed above the 100-day moving average. So two major resistance points have now been taken out. The 20 days crossed above the 50. That's a very bullish sign. It's very close to crossing above the 100. That's another bullish sign. Markets are overbought short term, and so there's a little bit less upside here for stocks near term. So, pullback wouldn't be surprising. But where stocks pull back will be important. If stocks pull back and kind of base along the 100-day moving average and then turn up, that's going to be a very bullish sign for a continuing momentum trend in the markets. If they pull back to the 50, hold that support level, that'll be a very critical turn. And if the 50-day moving average starts to turn up towards the 200-day moving average, which that'll happen if stocks continue to kind of hold up here, that's also bullish. So, there's a lot of things that are occurring right now. And as an example, today, the markets broke above their 50% retracement level from the peak of this year. So that's also a bullish sign. And last week, you and I talked about the difference between a bull market and a bull market correction and a bear market. Right. And there's a lot of anecdotal evidence that we're still in a bull market correction. We're not actually in a bear market. And so in a bull market correction, when you retrace the 50% mark on a retracement basis, the next level should be new highs. You should retrace all the way back to the previous.
Previous. So you're saying historically that's given a green light that said, okay, we've made back half. now we got the green light to go up to new highs.
Exactly. Now, and again, there's a lot of people sitting there going right now, it's like, oh, it's crazy talk, right? The Fed is hiking rates and tight. Yes, they are. And that's this is the big debate. On one hand, you've got the stock market telling you that it's kind of a green light for equities at the moment, right? And you need to have money allocated to the markets. On the other side of that argument, this is why it's so challenging right now, is that you've got the Fed hiking interest rates aggressively. They're not just kind of sort of hiking rates, they're aggressively hiking rates. Those rate hikes haven't worked their way into the economy or the markets yet. So, these rate hikes that we saw just recently won't show up until next year. M2 money supply is a negative on a year-over-year growth basis, and that'll show up in about 9 months. So there's a lot of things here that are going to drag inflation lower because economic demand is going to diminish. And we're going to see we're seeing more and more conversations about layoffs, unemployment. The jobless claims number ticked up, pretty sharply. Continuing claims are continuing to tick up here, all suggesting that you've got weaker economic growth. But see, that's good news, right? Because now you go back to the whole thesis, which is the reason we're all jumping into stocks right now is because I don't want to miss the bottom. And if unemployment spikes up, and if jobless claims spike up, and if the economy really starts to head towards a recession, that means the Fed's going to have to go back to QE. See, this is not a fundamental argument. None of this is a fundamental argument. It is all a bet on what the Fed's going to do. In other words, screw fundamentals, just bet on the Fed. And that's what the markets are doing here.
Yeah, and you and I have railed about this many times. I'm just going to do it real quickly here, but investing is dead. We have all been forced to become speculators to try to figure out what this small number of folks around a table at the Eccles building at the Fed are going to do, which is just ridiculous, criminal. It's no way to lead your investing public or the entire investment community. We should be busy looking at fundamentals and trying to figure out what a company is going to do and which one has better prospects and allocating capital that way. Instead, we're all just running around like chickens with their head cut off, trying to guess what a couple of old people around a table are going to decide to do.
Yeah, let me give you a really good example of that. We had this debate this morning when we were looking at our portfolio. So we have we added recently a couple of positions in NVIDIA and AMD. The stocks have gotten real beaten up here, and they're stocks we like long term. We want to own them. The debate comes around. Of course, there's 2 new bills that have gotten passed recently: the semiconductor bill, and then of course the Inflation Reduction Act, which has nothing to do with reducing inflation. It has everything to do with green energy. So, what bets do you need to be making in terms of green energy plays, right? So, we've been long Albemarle for a while for lithium because that plays, into the whole battery basis. But, now we've got to start looking at, what opportunities exist in hydrogen, because part of that bill is focused on, providing investment into hydrogen research, et cetera. But also solar charging, all these, wind power, all this other stuff. So, we need to start looking at, areas of the market that we need to have some exposure to because there's all this government liquidity coming in. But here's one of the interesting things. So in the semiconductor bill, right, the semiconductor bill is providing capital for basically building U.S. manufacturing plants for semiconductors.
Right. For reshoring manufacturing of chips.
Yes.
Yeah.
Which is great. That's fantastic. So there's about 10 companies that have domestic manufacturing, right? Maxim, Skyworks, AMD, NVIDIA, Intel. Now, from a fundamental basis, this is the debate we're having in our shop right now. From a fundamental basis, Intel is cheap. It is cheap all day long. Price to sales less than 1. PEs are probably around 7-8 times earnings. Pays out a dividend. Dead money. And this is a company that if you invested money in Intel 2 years ago, 3 years ago, or NVIDIA or AMD, you really did not make a lot of money in Intel. You made a ton of money in AMD and NVIDIA because that's where the money flows went to. But to your point, Adam, the reason I bring this up is that this is the challenge, right? This is the conversation we have. From a valuation standpoint, we should be buying Intel all day long. It's fundamentally very cheap. It's going to weather you in terms of a downturn in markets, et cetera. It should shield you. But if you want to make money, you can't buy Intel. You've got to buy the stocks that have all the money flows from passive investing. And so basically you need to own the top 10 stocks of whatever ETF you want to. If you want to, we talked about this a few weeks ago. If you really want to just track the market and buy individual stocks, buy the top 10 stocks of the S&P, go home for the day, you'll basically get the return of the index. But this is what we've done to the markets over the last decade. We've created this passive indexing monster that is now just sucking in capital. And is pushing the top 10 stocks of the index and others up. And even though you're sitting there going, we should have a bear market, we should be down 30% because of what's going on with inflation. And we're not. We're down like 12% right now, 10% for the year, running 8.5% inflation. That should not be happening, but that's because of all these passive flows. It was interesting this morning on CNBC, there was an article about Tiger 21. And if you're not familiar with what Tiger 21 is, it's basically a networking group of high net worth individuals, and they all kind of get together and they share ideas about where they're investing capital and this type of stuff. The average, by the way, you can't join Tiger 21 unless you have 20 million in investable assets. So, Adam, you're just shy of that. Let me know when to join it.
Not part of the Illuminati yet, but okay.
Yeah, exactly. But the average, I ran the average this morning. The average net worth is $116 million liquid for this group. So, now normally the bulk of their assets are in real estate and private equity, this group has stocks as their number one investment choice at the moment. And this started this last month. So now they're taking money and they're taking their cash reserves, which they've been overweight cash, and they're pushing that into stocks. So stocks are now making up 21% of their total portfolio, their total net worth. So 21, that's one of the higher levels that they normally carry. Really rich people, by the way, don't invest in the stock market. They invest in real estate, private equity, and they have about 3 years of cash on hand at all times. So they're very conservative in nature. Their goal is not to lose money.
Not to lose what they have. Yeah.
Yeah. So when you talk about, when they talk about, oh yeah, I've got an equity allocation, you're thinking, oh, they must have like 80% of their money in stocks. No, 20% in stocks, because the volatility, capital risk, and no real outcome protection, right? Fixed income makes up a big portion of their portfolio. Like I said, real estate, private equity makes up all the rest of it. So, but it's interesting because how are they getting allocation to stocks? They're buying ETFs, right? They're not buying individual companies. They're just buying sector bets on the market because they think the market's now cheap relative to where we were previously. So I think it's a very interesting dynamic, but these are really smart people with a lot of capital. They're buying ETFs, not buying individual stocks, because they pretty much come to the conclusion you can't pick stocks and win in this game. You just got to buy the sectors.
Right. Which of course makes the issue you were talking about even worse, right? You've got a lot of capital flowing into those passive instruments, and it's just,
exactly,
flooding the market unequally. It's so funny. I hadn't really heard much talk about Tiger 21 forever, and you're the second person this week to bring it up to me. And what saddens me to hear is not just that I and most of the viewers here are not in Tiger 21 or don't have the means to be in it, but is wealthy people are wealthy for a reason, right? They whatever made them wealthy in the first place that allowed them to amass means that they then use to maintain their advantage, right? So they generally have better information, better access, et cetera. And if they're moving their capital into something, it's usually because they know something, right? And so that's an argument for saying, look, stocks may have a better future ahead of them right now than we think, which I'm sure is maddening to many people watching this video right now, as it is to me to contemplate it. But as you say often, Lance, we don't have the luxury of trading the markets that we want to have. We have to trade the ones that are there. It doesn't necessarily mean I'm shifting my position and thinking that, okay, bull market and everybody jump full back into the pool. But that's a data point that we just have to pay attention to.
Yeah. It's interesting. So, if you look at our logos, right, for all of our different companies that we run, it's an eagle head. And the reason that we chose an eagle for our logo is because we're not bullish or bearish, right? So our job is to kind of look at the markets for what they are, kind of observe it from, the 30,000-foot view, and then make investment decisions based around what it is, and try to let the bull bears, kind of arguments, leave those to the side and just, evaluate them for what they are. But, try to weight them and try to allocate relative to what the markets are telling us. And so, one thing we talk about a lot is confirmation bias. And, again, this is always one of the big traps that we get into, is that we start listening to, some guy, some video channel with some guy interviews a bunch of bearish people. And so everybody gets, all bearish, or likewise, the other side, get some, no, I'm not talking about you. I'm talking about in general, but,
okay, I wasn't sure that was a veiled nudge.
No, it wasn't at all. But no, I won't mention any names, but there's other advisors out there that it's, no matter when you listen to them, no matter what goes on in the market, it's always bullish, right? So just, you got to be invested all the time. It's buy and hold.
Right.
And there's a whole
classic CNBC. Yeah.
Right. Well, and a lot of private podcasts and
there are YouTubers and podcasters
everywhere.
Both ends of the spectrum.
Here's my point. But there's a point. I'm trying to make a point here, Adam. Quit interrupting. The point is that we've got to be careful about confirmation bias. When we start listening to one set of opinions, we start thinking and it's kind of social media, right? You only hear whatever kind of silo you're in social media wise, that's all you hear. So it's interesting, in the mornings, I try to tweet out on our Twitter page. So if you go to @Lance Roberts, you can follow me on Twitter. And I try to tweet out one or two bullish things and one or two bearish things. And the whole goal is just to kind of keep that confirmation bias in check a bit. And what's fascinating is to read the comments, right? Because if I tweet out something bullish, I get all these comments about I'm an idiot because obviously the market's going down. If I tweet out something bearish, I'm a genius because, well, that's just who follows me, right? So I've got this silo of people that follow me that are expecting all this kind of bearish talk, and that's not the case at all. And again, you've got to evaluate, and to your point, Adam, is that we may want to have a bias of one direction or another. Look, I tend to lean more bearish, in my bias, because my focus is capital preservation. I have never had to have a conversation with a client in 30 years where I have to say, I'm sorry, I lost 40% of your capital, but this is how we're going to get it back. So I lean bearish because I tend to be more conservative as an investor. Fundamental values, those type of things. But I also understand that my job is to make money for my clients. And if markets are going up, I have to participate, and I have to do it in a way where I can manage that risk of participation against the risk of severe capital loss. And that's not always easy. And this is one of those times where it is a very difficult challenge to allocate capital, because there's, the market is really not attached to any fundamental idea. It's just all based on hope the Fed's going to make this pivot sooner rather than later. And there's no evidence from the Fed that that's the case.
Well, all right. So it's a great point. I hope that's the point that folks take away from this video, if nothing else. The rant that I want to conclude on is going to talk about this directly, Lance. And I got some other things that are related to it I'd like to talk about here. But I guess first, if there's anything else that you care to share about your process, because I understand it's got to be super hard right now. It kind of reminds me of this old Richard Pryor skit where his wife catches him in bed with another woman, and he says, "Honey, there's nothing going on here." And she looks distrustful, and he says, "Well, who are you going to believe, me or your lying eyes?" Right.
Exactly.
Right. And this is sort of a market where, if we look at all the macro data, we're like, there's a lot of real reason to be concerned here. But to your point, the technicals are saying it's time to party here, right? So your job at the end of the day is to, no matter what your philosophy is you just got to make hopefully money for your clients, or at least not lose it. So you've got to try to figure out, okay, what are we going to decide to do? I've got an angel on one side and a devil on the other, or a bull on one side, a bear on the other, and they're basically giving me equal volume in what I should do. How do you make that distinction?
And this is, it's really a great question, because that is, that really kind of identifies the challenge. So, just as example, right now we're underweight equities, and we realize we need to increase that equity exposure. So, again, the bearish side of us is saying, no, look, this doesn't make any sense here. We're heading into a recession. The recession hasn't come yet. As an example, earnings. We just got through Q2 earnings season, and we talked about the fact previously that earnings were way too elevated. Those had to come down. Well, just in the last 2 weeks, earnings have declined by almost 10% in just 2 weeks, earnings estimates going into 2023. So now all of a sudden, the market is starting to catch up with reality that, earnings are going to be a lot slower, growth is going to be slower, and those are going to be an impact. So companies are going to have to be, are going to have more of a challenge in meeting estimates going forward. Now, remember, a lot of this rally that we have right now is based on earnings not being as bad as expected. Now, that's a big caveat right there, right? We can't keep running the market up based on earnings being not as bad as expected. We've actually got to start having better earnings, and there doesn't seem to be right now any catalyst to generate stronger earnings growth. Everything seems to argue to the other side, right? The Fed's tightening rates, they're hiking rates, reducing QE. That's all designed to slow economic growth. As we said before, that's going to slow earnings estimates. So again, on a fundamental basis, there's certainly no catalyst here at this moment that's going to spur stronger economic growth, particularly with 8.5% inflation and even 6% inflation by the end of the year, maybe. That's certainly not going to augur for stronger economic growth. So earnings are going to be a challenge here over the next several months. But again, in the short term, the markets are doing a lot of really bullish things. So what we have to do is simply kind of move back to our technical analysis and say, look, if markets pull back to the 50-day moving average, find support, hold those support levels. If trends remain, across different measures, whether it's breadth measures, advanced decline lines, those type of things, if those remain bullish, then we need to allocate some capital towards equity risk, because the trend of the market is improving currently, and the technical backdrop of the market is improving. And again, markets tend to lead economic data. So, economic data and expectations have gotten very negative. So it wouldn't be surprising, we talked about this last week, that we could have maybe Q3, Q4 have show out, positive economic growth. Again, you just saw consumer sentiment tick up a bit, right? People have gotten so bearish about the economy that now anything that improves, a little bit lower gas price, I feel a lot better. That's going to potentially augur here for a little bit of economic surprise. We could see this market rally a bit. The bear market, if we're going to have one, and the recession is still likely 2023, because all this other stuff that's going on, monetary liquidity and tightening and all that, won't show up until early next year. So we could be in this period for the next 4 or 5 months where the media believes that we're back into a bull market. We certainly want to trade it. And that's the trap that historically kind of sucks people into a bear market rally and gets everybody all bullish. And then the bear market hits them, and then the rest of it goes on. So again, from a short-term basis, we realize that we have to use the market for what it is, but everything that we're doing, are trading positions, and we'll take them back off and raise cash when we need to.
All right, great. Thanks. So let's get to any trades you may have made over the past week. And as you answer that, if you can also just address, I'm going to put you on the spot just a little bit here, which is you just made a great exposition of sort of how you're making your determinations right now. And it's very clear that you distrust the market. You're not sure which way it's going to go. Everything's a trading position you can get in or out of. But just on a gut level, what is your gut telling you here is more likely? That we are in a resumption of the bull market rally and that new highs are in the future? Or do you think that this is the traditional bear market rally that sucks people in and then the claws come back out and it takes them back down again?
Well, I mean, logic tells me that it's a bear market rally, right? Okay. That's what logic tells me. But again, logic is based on a bit of historical analysis and looking back at previous periods. There's a very close analog between this year and 1974. Actually 73, 74,
Right.
and leading into that. And that's the last time we had inflation like we're talking now. There's also a very decent analog between what's going on right now in 2007, 2008. So, the thing about analogs, though, and I want you to be really careful about this, and people show these charts all the time. It's like, oh, this market's just like it was in 1973, 74. No, the price patterns are the same, but there's a lot of differences between
Right.
any period, right? And debt and income ratios and all those type of things. And I've got an article coming out next week at the website talking about this isn't Paul Volcker's 1982. They're very different environment that we're in now. So to your point, though, my logic leans to the fact that we're probably going to have a fairly strong rally. It's going to sucker some people back in, and maybe we even get back towards all-time highs, right? And that's going to be amazing. We'll be at 43, 4,400, 4,500 by, towards the end of this year. And everybody's like, well, how can that happen? And then the recession hits next year, right?
And just for folks watching, we're already at 4,200. I mean, we're not that far away from those numbers.
Actually, as of today, we're about halfway to 4,300. So, it's creeping up on us pretty quick. And this is where it gets really painful. And this is where investors are going to make mistakes is if you've been super bearish the market, this is going to start yanking at you to get back in the market, just like us, right? I mean, we're underweight equity. Now we're still beating our benchmark for the year, but we had a 600 basis point lead a couple of months ago. Now our lead's down to about 400 basis points over our benchmark. And if this market keeps running, the benchmark's going to catch us by the end of the year. That's just a function of math because we're about 40% equity right now out of our portfolio. So just the simple function, if the S&P keeps running, our benchmarks, the benchmark's going to catch up to us. But, so we've got this pull because we want to beat our benchmark. Our goal is to at least, perform with our benchmark or better every year. So we've got this psychological pull to add equity exposure, even though we know there's risk, right? So we're just as subject to that emotional pull as anybody else. And, as this market rallies, that pull starts getting stronger and stronger. And that's where a lot of people are going to finally capitulate and jump back in. It's like, fine, screw it, I'm in. And they're 100% long stocks. And that's the peak of the market. And again, so I wouldn't be surprised. Don't be surprised if this market has some seriously more legs to it. And then, we get into next year and that's where we start seeing recessionary indicators and a lot of other things and, reevaluation of valuations as prices of stocks start to come back down and to calculate, for a slow earnings growth environment.
All right. Well, we've used the term a lot in the past months. This is a really treacherous investing environment for the regular investor, and you're just sort of, completely validating that here where, especially, the folks that had been pessimistic of the macro situation, then this year happened and it seemed like validation. And so there's probably some percentage of folks out there that loaded up on, the short side of, all right, this is it. This is when the market's really finally going to have its clearing event. And they've been getting killed as the market's been recovered here. And probably a fair amount of this rally's been for short covering and stuff like that, right? And to your point, the pain trade is up at this point in time. So anyways, we don't know what's going to happen next, which I think makes these weekly check-ins so valuable in a time like this, Lance, because we're just trying to piece together each new piece of data as it comes in to say, okay, which side of the story does this thing support?
And look, so real quick though, that's a super important point is that, when we talk about stuff on our weekly check-in, right? Whatever we say is only good until next Friday. And I know that sounds wishy-washy, but that's really I can say, look, I suspect that next week, we're not going to have a lot of gains in the markets. Markets are very overbought. We're 2 standard deviations above the 50-day moving average right now. Markets are overbought on all of our measures. That generally argues to the point that you're going to have a reduction in gains. So I would not be surprised next week that we don't see a little bit of profit taking here, a little bit of consolidation wouldn't surprise me at all. That forecast is about as accurate as a weather outlook. And, and is only good for about 3-4 days. So, that's why, if you're making any bets in your portfolio that, I think the dollar, and this was early this year, right? I got people calling me up. The dollar's going to zero, the world's ending, and commodities are going to the moon. And I was like, be real careful making one-sided bets because those can work against you real fast. And we've seen exactly that happen, right? Commodities took a big tumble, dollars come down a bit, so, and the world hasn't ended just yet. So, you've got to be careful. This is why you really have to manage your money week to week. And, whatever view we have this week could very well change next week, because why? The data is going to change next week, and the data doesn't remain the same. So as the data changes, we have to change our outlook and our investment strategy to fit the data.
All right. Great point. So trades, are you placing any trades right now?
We bought, so we did a little bit of shifting in our energy portfolio this week. We like the energy sector. We had taken a lot of profits out of it back, back in April, May. I'd written this article about how, likely oil prices were close to a peak, and we reduced our energy exposure. So we've been underweight energy. This week, we actually did a little bit of shifting, and our timing was actually, we got lucky on our timing. We had a big rally yesterday in energy stocks, but we had sold our Marathon Oil position. We like Marathon Oil as the company a lot, nothing wrong with it. The only reason we sold it was that we wanted to boost our dividend yield in our portfolio. So we shifted our Marathon exposure into Devon Energy and ExxonMobil. ExxonMobil carries about a 3% yield, and Devon carries about a 5.5% yield. So valuations are still very cheap. Earnings growth is very strong for these companies. Again, nothing wrong with Marathon. If you're long Marathon, don't go sell it just because we did. We simply were just making an allocation decision to boost the dividend yield in our portfolio. So again, not poo-pooing Marathon, it's fine. We were just making a decision to consolidate our energy holdings and increase those weights to boost the dividend yield in our portfolio. So now we're carrying about a 4% weight in our portfolio in energy. And we also added 10% of our portfolio to Bill this week, which is a short-term 1 to 3 year ETF owning T-bills, 1 to 3 month T-bills. And the reason we did that is that yields about 1.5% to 2%. And so again, we're sitting on we're sitting about 30% cash right now in our portfolio. So basically, we're just trying to get some yield on our money market.
Just trying to get a safer, higher yield off of that thing.
Yeah.
All right,
and with the Fed hiking rates, and since it's 1 to 3 months treasuries, as the Fed hike rates, that yields goes up.
Right. You ride the hikes. All right, great. And look, if the market continues to go up from here, do you see yourself making more trades going forward, being more active than you've been for the first half of this year?
Yeah, for sure. This is a very dangerous market to short. So, we're probably not going to be shorting the markets right now, only because, again, I think there's a great short setup coming. And when we get to that point, we'll short against the market to hedge our portfolios. But right now, there's so much. There's still a decent gap. We talked about how negative sentiment had gotten in the markets, right? And that very negative sentiment was bullish by contrarian nature. Well, we've only recovered now that sentiment's improving rapidly, right? I mean, we're getting a lot of bullish sentiment going on here. People are getting very bullish, but those indicators are not back to overbought yet. So we're not back into that extreme greed territory just yet. We'll get there soon. And when we get to that more extreme greed level, that'll be a better opportunity to short right now. So right now, what we're looking to do is kind of nibbling around the edges in the portfolio, add some exposure where we can find some opportunity, looking for pullbacks in some areas that we like in some fundamental companies. And and one thing to don't forget is that value has performed very, very well this year. We run a model in our shop that is for very, very conservative investors, right? We have some investors that are like I don't want to lose any money type thing. So we built kind of an all-weather type structure portfolio, and in that portfolio, it owns 10 deep discount value corporations, and those stocks are up about 6% this year versus the market. So I mean, they're actually positive for the year, and and then that just goes to show you that value has been working very well this year, continues to work, continues to help shield portfolios, as a whole. So, don't discount, even though we're talking about a market that doesn't pay attention to valuations, don't dismiss buying valuations in your portfolio because it does matter.
All right. Well, great points. All right, thanks. So I want to get to our rant. I've got a couple other, very worthy topics to discuss, and we're just going to be able to just lightly touch them on here because I think you and I could spend a half hour on each easy. But I feel it's important just to at least give folks these updates, and I'll let you give any quick comments you want to make, and then we'll hopefully get to the ending part of this. All right, so I want to talk about the housing market for a minute because things continue to darken there. I live in the San Francisco Bay Area, and San Francisco has now just become the first major metro to see lower prices on a year-over-year basis. So this is the first domino falling here. A lot of the other major metros are seeing their year-over-year growth gains shrink pretty quickly here. So the trajectory isn't good. The main thing I wanted to mention here, though, is that I'm sure know Robert Shiller, the creator of the Case-Shiller Index for housing. He's basically America's godfather when it comes to housing analysis right now. Here's a quote he put out there the other day. Home prices haven't fallen since the 2007-2009 recession. Right now, things look almost as bad. Existing home sales are down, permits are down. A lot of the signs, there's a lot of signs that we'll see something. It may not be catastrophic, but it's time to consider that. Right. So this is the kind of thing, remember the old commercials when E.F. Hutton talks, people listen, right? Like when Robert Shiller talks about the housing market, we should listen in general. But when he starts comparing where we are to the beginning of the bust from 2007 to 2009, we should really be listening. So you and I have been waving, flags around our concerns about the housing market. I think this is real validation that we should be probably even more concerned than we've been. What do you think?
Well, yeah, no, I think you're absolutely right. So first of all, I don't want anybody running off from that comment saying, "Oh my God, Adam just said another housing crash is coming." Okay, we don't have the subprime debt issues that we had back in 2007, 2008. Again, markets are very different. So just grain of salt, right? But there's a lot of similarities. And back in 2007, I was doing my radio show back then as well, and we were talking about on the radio show back then. I go, there's a housing bust coming. And the reason the housing bust is coming is because have you been paying attention? This is 2007, mind you. Have you been paying attention to like Bravo and HGTV and like all these house flipping shows and everything? Is like, flip this house and buy this house and these real estate sells houses and all this. Well, all that went away after the financial crisis, right? A lot of those shows kind of disappeared. Well, they're all back. Right. They're all back. I mean, Melissa McCarthy's got a house flipping show now. I mean, come on. The Property Brothers are just killing it right now. I love those guys, right? They do some great work, but they are just, killing it in terms of their brand on, flipping houses, doing real estate and all that. Back in 2007, people were quitting their job to become real estate agents. I've had like 8 people tell me just in the last week that they're quitting their job to be a real estate agent.
Oh, really? All right.
And so my point is that there's a lot of similarities to, market peaks, and whether it's in stocks or real estate or things else, and that was one of the driving factors why, my wife and I sold our house, is that, it's just when you kind of looked around at what people were putting houses up for sale, for, it was like, are you kidding me? And then you would see a contract on them like in a day. It was like, this is not sustainable. And, if we miss this opportunity to downsize, it's going to be 5-6 years before we get this opportunity, or 8 years or more before we get this opportunity again. And so that was really the driving factor. It's not that I enjoy, selling houses and moving, because moving sucks. But, but it made financial sense, at the time, because of what's going on. And I think you're seeing that around a lot of parts of the country, particularly out in California, particularly where you live, Adam, out in San Francisco. Our neighbor, as an example, our neighbor that lived next to us at our old house, they have a house in San Diego. And she's a real estate agent, and her husband works for Shell. And so they have a lot of friends in Houston. So their primary house is in Houston, and they have a house out in San Diego. Now, interestingly enough, I asked them, I said, "Why don't you sell your house?" And they're like, "Well, we can't because of the taxes." It's not our primary residence. So if we sell it, it's like 700 grand in taxes, and we just going to leave it to our kids because it doesn't make sense to sell it. But here's the point about this is she's trying to find a house for her son in San Francisco because her son works in San Francisco. And she's like, these houses are up on the markets and they list them at 1.2, but they won't even talk to you unless it's $1.5 million or more. Right. And these houses are like 900 square feet. Right.
And by the way, 1.5 million is the average house price for San Francisco. It's 1.5.
Yeah, it's just absolutely crazy. And she's like, these houses, A, aren't worth it. And B, who the hell can afford them? My son can't afford a $2 million house on what he makes.
Right.
And this is just, but this is exactly in 2007. I was out in San Diego and Laguna Beach for the annual PIMCO conference. And my taxi driver picked me up at the airport to take me to the conference. And he was telling me about his $2 million house that he had just bought. And he was so proud of it and so happy. It was his first house he bought, $2 million. I'm like, how did you afford that being a taxi driver? He's like, well, it was no money down, no interest, blah, blah, blah. But, while we don't have ninja loans, we have 3% money down loans.
Right.
So there's a lot of people buying houses they can't afford. And look, and even though we don't have subprime mortgages and all this other stuff, and I'll shut up now, but, I still think there's a significant risk of a downturn in prices that is not cataclysmic like we saw in 2008. It's not going to force, companies out of bankruptcy, but I think we're going to see bankruptcies tick up. I think we're going to see, defaults tick up a good bit here. And I think we'll see a lot of these younger millennials that ran out and bought houses in the last couple of years with their stimmy checks, really regret that decision for overpaying for their houses.
Yeah. Well, housing went up, 20% year over year. If we just see a reversion of the past year's activity, was a lot of people who are going to be way underwater in their house, especially if they put down a 3% down payment. All right. So great points. Reminder, these are supposed to be the short answers. But to your point there,
topics.
Yeah. But to your point there about both how crazy things are in San Francisco, but that it may be a bellwether here, and that you think there are markets where people may lose some good money. Here's an anecdote that was in the Bloomberg report that reported that San Francisco is now down year over year. There was a house that was listed in April at 9.5 million, which again is sadly not a crazy price for San Francisco. It wasn't selling. So they took it off the market and they relisted it in June for 7 million. Didn't sell, took it off the market, put it up for auction last week at a price of 4.5 million. So in the span of 3 months?
Yeah.
Went from 9.5 million to 4.5 million, no bids at auction. Now, I don't know the details of this house. Yeah, I don't know the details of this, specifically this house, but I mean, that just shows that, hey, if somebody bought that thing anywhere around 8 or whatever to try to flip it at 9.5, right? And then no one's buying at 4.5. Somebody's sitting on a big loss in that property. All right. Okay. So anyways, lots of reasons to be compared about housing. And I really just wanted to bring up the Schiller quote to say, hey, even irrespective of what Lance and Adam, two random guys on the internet, thinks, probably the smartest, most experienced housing analyst is very worried and making comparisons back to 2007. Yeah. All right. Just on the layoffs topic, which we tend to touch on every week, the hits keep continuing. The names in the media the past day or two: Groupon, Snap. There's a company called Calm, which is a big wellness app, and I only bring it up here. They just announced a 20% layoffs across the company. A guy used to work with at Yahoo. Actually just became CEO of Calm, and it looks like they hired him to lead the company, but to also be the guy to come in and say, look, sorry, I don't know many of you, but we got to cut 1 of every 5 of you, my first week here. So again, we're seeing that layoff train continue to build off steam. And then another personal connection story here. This has not been a good year for hedge funds. Right. Hedge funds really got caught because they're all about being long the market, especially the crazy growth tech stocks that just got trashed this year. And so I just want to bring this up to say it's not just a treacherous investing year for the average investor. It's also a treacherous investing year for the pros. So there's a bunch of what are called Tiger Cubs. These are guys that worked for Tiger Management, which was one of the best investing funds that spun off some of the best investors over the past couple decades. So these are the brightest, shiniest stars, the A+ students. They're just getting wrecked. Tiger Global is down 50%. Light Street, which is started by a Tiger Cub who actually I went to business school with and know quite well, that's down 40% this year. Maverick Capital's down 35%. Melvin Capital, which was the one that got just caught in the crosshairs of the whole meme stock revolt, within GameStop and AMC, they're shut down at this point. They're now being investigated by the SEC. So we're seeing a lot of decimation amongst the pros at this point as well, which to me just says, hey, look, this is a really friggin' hard market to navigate.
It is, and look, it is, it's kind of an interesting telling story, right? Is that these are supposed to be the smartest, brightest guys in the room, and got completely wrecked. But that happens in markets, right? And this kind of goes back but it happens a lot to retail investors. You just don't hear about it as much because they don't get the headlines. But there's a lot of people I've talked to this year that have been really damaged by this market because they made a lot of wrong-sided bets. They were either betting on the end of the world, or they were betting, on hot stocks and archetype stocks, et cetera, and didn't realize how much risk they were taking on. As we talked about before, that's what bull markets do. And the important thing about 2020, 2021, it was a very easy market to invest in. And what a bull market like that does is it covers up all your mistakes. So you can basically, buy any stock and it's just going to go up because the market's going to drag it up. So you can be making huge investment mistakes and not even know it. I mean, how many people do you know were buying American Airlines and Carnival Cruise Lines and Hertz, which was bankrupt at the time? They were buying, Hertz, and there was no penalty for chasing those type of companies because of all the liquidity flowing in the market. Well,
right. No penalty for ignorant or reckless decision making.
Yeah. And I just ran an analysis because I'm about to publish an article about, when we get to the bottom of the bear markets, you won't want to buy stocks. But there's a lot of those companies that even after this rally are still down 50, 60, 70% from their 52-week highs. So, there's just a ton of devastation that came across the market and impacted a lot of retail investors that, they likely won't come back to the markets for quite some time.
All right. Well, look, to me too, it shows that we're sort of at the end of an era, right? So it was the easy investing style. It wasn't just the last year, right? I mean, it's take out the pandemic, the past, 11 years or so have been pretty easy, right? For anyone throwing darts. The fact that these guys are getting wrecked right now, to me, suggests that something material has changed, right? And right now we're in the interregnum period between trying to find out, did it change forever or for good, or is the destruction over and we're back to new highs? And as you said, we're going to be finding that out on a week-to-week basis from here. But it basically just says, look, this is the type of market that's eating up these big star pupils. The rest of us who don't have all those advantages better proceed with some real caution here. All right, two more quick points, and then I'm just going to get straight to the main closer here. I just wanted to validate some things we were talking about here. So we went on a rant, it might have even been last week, about Speaker Pelosi's trip to Taiwan. And I think I was just saying, why now, right? With all the risk in the world, why now? Well, it turns out that last week, or on July 28th, they just, I guess, published the transcript of a call between Joe Biden and President Biden and China's Premier Xi, and where Xi said, hey, look, now is not the time for a full-blown crisis. Please don't do this right now. He was begging for President Biden to intervene and not have Speaker Pelosi go visit Taiwan. And you can, whether you think it was a good or bad thing, I'm not trying to change your mind. I'm just reflecting here that, like, hey, even the premier of China was saying, like, dude, we do not need this right now. Why are you guys doing this? So I think we were right to be concerned about the instability that was adding to a very unstable situation. Other thing too, just today, the GAO just came out with a report saying that forgetting about future loan forgiveness that the government may do, we've just redone the numbers. And since the government has gotten involved as basically the main lender in the housing market, which happened, about a decade or so ago, taxpayers have now lost 197 billion, so almost 200 billion, right? So this was sold as, hey, we're going to help a lot more people get, college educations, and we're going to make money for taxpayers. Well, now we have this situation where we've got a ton of people with degrees that they have no hope of paying off for the rest of their lives, given the quote unquote value the degree gave them, and taxpayers are even worse off. So kind of classic government solution, got involved, made everything worse.
Yeah, well, and is that really surprising? And when you talk, and again, when you start going down the pathway of forgiving student loans, and look, I know a lot of the younger generation are like, yeah, forgive my student loans, I don't want to pay it back. Look, you borrowed the money. It's your responsibility, and there's this thing called contract law that's very important to, the underlying structure of the economy and how it works. And we keep eroding that. We did it a lot during the financial crisis because we let people out of their mortgages, which, I get it, there's financial crisis, but there's this thing called contract law, and it's very important to how the economy and capitalism actually operate over time. And, and now we've got a big clamoring, and everybody wants to get votes, obviously, right? So we've got elections coming up, everybody wants to get votes. So, this idea of forgiving student loan is great, but it's such a slippery slope. Once you start forgiving student loans, what are you gonna do about the next people that take out loans? You're gonna forgive those loans too. What about the people that paid off their loans? Yeah. This is a huge trap that people are walking into. And again, at the end of the day, it's taxpayers that are the ones losing money, right? This isn't free money. It just didn't show up somewhere. Somebody's actually sitting on top of that student loan debt. They loan the money for it, and they expect to get paid back.
Right. Well, so you and I we've ranted on this. We could rant on it for an awful lot further, but that last point I think is the key one, which is there's nobody winning from this, right? There's a lot of people out there with degrees that aren't very valuable for them, and they've got this massive debt that they're now praying, hopefully gets forgiven, or at least part of it gets forgiven, but there's no guarantee on that, and the taxpayers are worse off. Really, the only people that are making out like bandits on this are the lenders themselves, who are collecting all their fees, and the people in the higher education cartel who are, being able to charge exorbitant amounts that the market will fund right now because it's a subsidized market. So anyways, just wanted to say we were right to continue railing on this. All right, so here's the rant, which is I posted on Twitter about something I did the other day, and it was the response I got on Twitter that I want to talk about here briefly. So I went and updated my financial plan. So sat down with an advisor, we went through the software, we, my wife and I sort of, reevaluated every assumption that we had in there. We changed a bunch of things. And I found the process, as I always do, I found the process just incredibly useful, incredibly helpful. You can, once you have it all in a good program, you can run a ton of sensitivities and say, okay, well, what if we retire a couple of years later, or what if this investment we want to make costs more, or what if, our income goes down here, or whatever. You can play all these different scenarios and see how they come out. And you begin to get a good sense of what your probabilities are, right? And to me, this just sounds like prudent financial planning, right? There's no guarantees in the world, but you're able to sort of see with probabilities and, surprising curveballs aside, if we do the following things, our odds of having outcomes we want or don't want, vary by these different degrees. So you can really use that to prioritize your actions going forward. Okay, I need to make more money. I need to work longer, or hey, we can maybe do this sooner than we thought, right? Maybe we can be a little more generous with other parts of the family if that's what our priorities are, and all that type of stuff. So I put this up on Twitter and just said, hey, look, I did this, found it super helpful, really recommend that people do this. And had a lot of people say, hey, great reminder, Adam, I really should do that, or it's been a while, I should do it. But kind of what we were talking about earlier, Lance, I had a lot of people say, hey, you can't model the World Economic Forum, Build Back Better, you're going to own nothing and be happy. They're going to take all of our money from us, and we're just going to be serfs. Or you can't model central banks releasing CBDCs and trapping us all in some new monetary system or whatever. And it's sort of this fatalistic, like, the game is rigged, so why even try, right? And, my whole point here is sort of like, well, look, one guy said, hey, look, you use the Mike Tyson, everybody has a plan to get punched in the mouth, right? The no battle plan survives first contact with the enemy quote. And I was like, yeah, but you can also throw back the quote, to fail to plan is to plan to fail, right? Like, in other words, like, if we don't try to control the things that we can control, then yeah, we're just letting fate roll the dice and hapless victims to what comes next. A big part about being about being a good steward and charting your way to the financial destiny that you want is taking control of the things that you control and then implementing risk management tools around the rest. And yeah, just like we're not going to be able to do much if a meteorite hits the earth and causes a mass extinction, yeah, there are going to be some probabilities that are outside of our control, but a lot of those are lower probabilities. And we can still put hedges, we can still put emergency funds in places and stuff like that to act as cushions here. So where I'm kind of going with this is to your point, Lance, that there's some people that are so tied to the mast on one certain philosophy, like, the dollar's going to zero, or we're going to have the great reset and the markets are going to just crater and every stock's going to zero, right? It's like, well, I mean, yeah, maybe that could, but that's probably not the default probability here. And people do the same thing on the upside. So my point is like, I can't think of a good rational argument not to try to think through a plan for your future and then begin to, execute against it again on the things that you can control, and not just let some sort of philosophical fear or dogma prevent you from actually taking steps because you're just thinking it's already all preordained. So I know you deal with people in this all the time. So what's your reaction here?
No, you're absolutely right. And this is, so we do things a little bit differently in our shop around financial planning, which I think are critical to understand. First of all, I can't tell you how many people I meet with that come in and they bring me their binder that's, this thick with their financial plan that they have done somewhere, previously. And they like, okay, well, I have my financial plan, it's already done, so I don't need yours. And I'm like, okay, that's fine. You don't have to do ours. We can use yours. It's fine. Now this one's 10 years old, mind you. Have anything changed? Well, yeah, a few things have changed. I go, well, then we probably need to redo this a little bit for, update it. The problem is that financial plans are not a be all end all. And again, just because you have a financial plan and it maps out, if you do all these things, this is where you're going to be. That's not what the financial plan is for. It's a roadmap. And, as you're driving, and my mother is when we used to go on vacation. So when I was growing up, our family vacations were you got in the car and you drove places. Like we drove to Canada from Houston. So, and my mother was the navigator and we were constantly lost because she would have her scenic routes that she would take along the way. And
go see the largest ball of twine, all that stuff.
Well, no, it was totally accident. We saw those things only out of pure accident because she missed the turn. So anyway, she was telling and of course, the majority of the fights between my mom and dad on vacation were her navigation skills, which were terrible. But it was great, right? Lots of good family time. Here's my point. When you're driving and you make a wrong turn, right? Something happens. Then you get out your map and go, okay, well, what do I got to do to get back on track? And so you make those adjustments. And to your point, that's what you do. And so this is why for us, the financial plan provides two key ingredients. So first of all, when we do financial plans, I don't know how you did yours, but a lot of financial plans use stagnant rates of return. They say, well, if you assume a 6% rate of return or 5 or 4, or pick a number, then you'll be here. We use variable rates of return over time. We front load bear markets. We, use, higher rates of inflation. We lower asset returns based on valuations. And so we do all these adjustments to compensate for what might happen in terms of market volatility. The second thing is that plan is what ultimately drives the asset allocation model. So if you come in and say, look, I need to get to, this amount of money by the time I retire, and this is how much I'm saving and spending, et cetera, you only need a 4% rate of return. And so you don't want to build a model that generates 5 or 6% rates of return if you only need 4, because you're exponentially increasing the amount of risk that you're taking, which is what leads to loss. And we talked a little bit about this last week. So that plan really drives the allocation model. Now we update that plan every single year. So every year when we meet, we have our annual meetings with clients, we update their financial plan, run new assessments, because things change and because the markets change. This year, it's interesting. We've got a lot of plans that we're renewing, and they're like, wow, this market, the market's down this year. Our portfolios are down a little bit this year because of the markets, and we're like, you're fine. You're still within your 98th percentile of success. We already accounted for, volatile markets, and no changes are needed. You're completely fine. And they walk away. They're like, okay, good. I'm fine. The problem with not having that type of roadmap or that map to follow is that when things occur like this year, all of a sudden you don't know where you are. So you stop doing everything you should be doing. You stop saving, right? You stop investing in the markets. You stop putting money into your investment accounts because you don't want it to go down. And you start making all the mistakes that you shouldn't make, but you are, because you don't have anything to follow. And so the financial plan for us is really that whole roadmap that we base everything around, and we update that every single year.
Great. And if I can just reinforce that point you made, because I was reminded of how useful this is in all the different sort of scenarios that we were running, is, first off, my wife's a therapist, right? A marriage family therapist. And just like with couples, like with getting married, right? There's lots of conversations that you benefit from having before you get married. Do we want to have kids? Where do we want to live? What kind of lifestyle do we want to have, right? If you have those conversations before you get married, you have a much higher probability of having a really happy marriage, because you're entering it like-minded. If you just marry somebody and then you find out along the way that you guys have different goals, different opinions on important things, well, that's where a lot of strife can occur, right? So, at the end of the day, it all comes down to sort of communication and planning. This is just the financial version of that, right? So, you come up with your goals and when you want to retire and certain things you want to do and whatnot. And then as you start playing around with the variables, you can see that, oh my gosh, if I work for 2 more years, that has way more, that increases the probability of us hitting goal X way more than putting Y% or Y dollars away every month more than we are right now, right? So when you don't have that intelligence of the levers that you can pull going into the future, you don't really know which ones are the important ones, right? You're just kind of pulling them randomly. I think maybe if I do this, it's going to help. What's great about these plans, especially if they're in a software program, is you can really see, oh my God, that lever is like 3 or 4 times more valuable than that lever for that goal, right? That's so, when you're in an uncertain year like this one, and you're trying to figure out, okay, if I need to kind of cut somewhere, where do I cut? Do I cut in terms of what I'm putting away in savings? Do I have to increase my hours and increase my income by a certain amount, right? These automatically adjusting plans or whatnot are hugely valuable and actually helping tell you where to be placing your priority given those goals. So I'm glad to hear that you guys do annual updates with folks. I kind of, every time I do this, like I said, I just walk away from the experience saying, God, that was super duper useful. And I can't think of a reason not to do this. And as you said, Lance, because you have a plan, it doesn't mean it's going to happen, right? It's not a guarantee. And if you do everything right, doesn't necessarily, if you follow the steps, doesn't necessarily mean you're going to get the guaranteed outcome, because just stuff happens, right? But by not taking those steps, you can pretty much guarantee you're not going to hit any goals that you might have, right?
Yeah, I think your quote is, plan, if you fail to plan, you plan to fail, is much more powerful than, any other really kind of structure. And look, honestly, what I learned from our conversation is that being married to a marriage counselor means you never win an argument. So
no, that's true. I'm not sure if that's the marriage counselor part of her though, but I think there are a lot of husbands out there that feel the same way, but
yeah, I know I never win either. So it's just, it is what
I think
it is.
just having a spouse that's smarter than you already puts you in the hole right away.
Yeah, absolutely.
All right. Well, look, so yes, don't let, any major fear or any major dogma keep you from actually trying to, cobble some intelligent plan together and focus on controlling the things that you can control. Okay, well, look, as we wrap up here, a couple important resources to direct folks to. One, we've been talking for many weeks, months actually now, about the retirement planning seminar that we told folks we would do for them. We are now going to do that. We have the date. I think we announced it last week. It's going to be Saturday, August 27th. So that's 2 weeks following the release of this video. We're going to do it here on the YouTube channel, right at the same bat time, same bat channel. We are not going to be using a webinar software like Zoom, so you don't need to register. You can just come here to this channel then. If you want to just remember a URL to go to, you can go to wealthion.com/retirement planning. So that'll redirect you to that live experience when it goes live on Saturday the 27th. After we record it live, we will then just run it as a replay here on the channel, so that URL will still work. If you missed the live event, you can still watch it. And then also, folks, the Wealthion Fall Online Conference, I mentioned that last week. That is going to be on Saturday, September 24th. This is the last day, the day this video airs is the last day that the alumni discount is available. If you're an alumnus of a past event, if you haven't done so yet, please go to your email inbox. You'll have emails from me there with the link to get the alumni discount. You're getting the lowest price before we open it up to everybody else. Everybody else, this is now available to the public starting Sunday, August 15th, which is the day after this video is aired. To go sign up and claim that early bird price, it's almost a 30% price discount. Go to wealthion.com/conference. All right. So for the next couple of weeks, you'll be able to sign up there and get the early bird price, secure your seat. Please make sure you go do that. It's going to be a phenomenal conference. I've run through all the names in the past, but real quickly, if you haven't heard them, Lacey Hunt talking about the Fed, Lynn Alden giving her macro outlook, Matt Taibbi talking about Wall Street and media capture. We'll have Grant Williams and Stephanie Pomboy. We'll have Alf Peccatiello talking about the bond markets. We'll have Brent Johnson talking about the dollar and other currencies. We'll have Doomberg talking about the energy markets. We'll have Rick Rule talking about hard assets. Mike Maloney talking about precious metals and crypto. We'll have Jeff Clark talking about mining stocks. And then we'll have live Q&A all throughout the day with a lot of those experts, as well as with our financial advisors like Lance and the guys at New Harbor. So guys, this is going to be an amazing day. Make sure you go become part of that crew, signing up early and getting that discount. And with that being said, we just talked about the importance of a financial plan. We talked about how treacherous these markets are. It is such a tough time for investors to navigate this and preserve their wealth. Folks, you really should be talking with your financial advisor about everything that Lance and I talked about here. If you've got a good one, great. Send them this video and just say, hey, explain to me how I'm well positioned for all the things that Lance and Adam just talked about. If you don't have a good one, or you'd like a second opinion by one that understands all these macro issues, maybe even Lance and his firm, go fill out the short form at wealthion.com and set up a free, no strings attached consultation with the financial advisors recommended by Wealthion. Doesn't cost you anything. No commitment to work with these guys. It's a pure public service. We just want to make sure that as many people as possible are preparing for, navigating this very, very uncertain market. And last, if you enjoy these weekly market recaps with Lance, half as much as Lance and I do me a favor and support this channel by hitting the like button and then clicking on the red subscribe button below, as well as that little bell icon right next to it. Lance, it's been wonderful. Thanks so much for giving us another week, buddy.
Yep, absolutely. We'll be back here next week.
All right. Yep. And everybody else, thanks so much for watching. Have a great weekend.